People talk about achieving 30% a year like it's magic. It's not. It's arithmetic powered by patience and discipline, two things most people don't have. Everyone wants extraordinary results, but nobody wants to live an extraordinary life. They want to act ordinary, spend like idiots, diversify like cowards, and still expect returns like geniuses. It doesn't work that way. In my lifetime, I've met thousands of investors. Maybe a dozen were capable of sustaining even 20% a year. And of those, only a handful ever understood why they succeeded. The truth is, you don't get 30% by doing what's popular. You get it by avoiding what's stupid. That's the entire game. Let me make something clear. A 30% annual return isn't achieved by chasing the next big thing. It's achieved by not doing the next dumb thing. Every cycle, the market invents new ways for people to lose money, and most of them line up to volunteer. In the 1960s, people went broke chasing conglomerates. In the 1990s, it was dot-com nonsense. Then came subprime mortgages, crypto, and meme stocks. Different eras saw stupidity. Human nature doesn't evolve as fast as technology. That's why the same old traps keep working. You can't compound at 30% by copying other people. The crowd is never early. The crowd is never rational. The crowd is never rich. If you need reassurance from others, you've already lost. Real investing is lonely. It's uncomfortable. It's boring 90% of the time. People ask me, Charlie, how do I get rich? And I tell them, sit on your ass. But nobody likes that answer. They want action. They want excitement. They want dopamine, not results. The irony is, the quieter you are, the richer you get. The more patient you are, the faster your wealth compounds. It's a paradox most people never grasp. I wasn't born rich. I didn't inherit a fortune. I built mine the old-fashioned way by staying sane while others went crazy. During the Great Depression, I saw what financial stupidity looked like up close. People took risks they didn't understand, borrowed money they couldn't repay, and then cried when reality called in the debt. It left a scar on my brain. I learned early that survival matters more than brilliance. You can't earn 30% a year if you're wiped out once. So my rule number one was simple. Don't go broke. Not once. Don't ever. If that sounds boring, good. Boring is how you win. Excitement is how you lose. Let me give you the ugly truth about 30% returns. They're not sustainable every year. Even Buffett didn't do that. But he came close because he avoided the disasters that destroyed everyone else. If you can avoid stupidity for 50 years, you'll look like a genius. People will think you had some secret formula. You didn't. You just refused to self-destruct. It's easier than it sounds, but harder than people want it to be. Because saying no again and again requires more strength than saying yes. To get 30%, you don't need to predict the next Amazon. You just need to avoid the next Enron. You don't need to own 100 stocks. You need a few great ones and the patience to hold them through boredom and panic. That's another rule people hate, concentration. Academics call it risky, but ignorance is riskier. If you don't understand what you own, 10 stocks are too many. If you do understand, 10 are plenty. We made billions because we bet heavily on what we knew and ignored what we didn't. That's not courage. That's common sense. But common sense is rare in the stock market. So when people ask me how to earn 30% a year, I tell them this. Stop chasing numbers. Chase rationality. Chase patience. Chase the ability to say, I don't know. Most people can't do that. They'd rather sound smart than be rich. They'd rather predict the future than prepare for it. They'd rather trade than think. You don't need superior intelligence to achieve superior returns. You just need superior character. And in investing, character looks like sitting still while everyone else panics. If you can master that, 30% isn't impossible. It's just uncommon, because uncommon behavior is the only path to uncommon results. That's the first rule of earning 30%. Be the rare person who doesn't act like everyone else. People love talking about how to make money. Nobody wants to talk about how not to lose it. That's why most investors end up broke or close enough. They focus on upside and forget gravity exists. They want to fly but never think about landing. And that's how they end up splattered on the pavement of their own stupidity. I've always said, it's not the brilliant who survive, it's the careful. And in the long run, survival is the single most underrated edge in investing. When I was young, I watched entire fortunes disappear overnight, not because the people were dumb, well, some were, but mostly because they were overconfident. They borrowed too much, speculated too often, and ignored the simplest rule in finance. Never risk what you can't afford to lose. That rule sounds dull. It won't sell you a book or fill a seminar hall, but it will keep you rich long after the speculators have gone bankrupt and reinvented themselves as financial influencers. That if you want to compound money at 30% a year, your first priority isn't profit, it's endurance. Compounding only works if you're still standing, and debt is the fastest way to fall. The world loves leverage. They call it using other people's money. I call it borrowing disaster, because the moment you add leverage, the margin of safety disappears. And once that's gone, all it takes is a little bad luck to wipe out years of progress. People forget luck cuts both ways. It helps you on the way up and destroys you on the way down. Buffett and I have watched this play out for decades. Every boom brings a new generation of geniuses who think they've reinvented capitalism. They build castles in the air with borrowed bricks. And then, when the tide goes out, they learn they were swimming naked. You don't need to be brilliant to predict that outcome. You just need a memory. And apparently, memory is rarer than IQ. The problem with leverage is psychological. It flatters the ego. It makes you feel smarter than you are, until it doesn't. When everything you own depends on everything going right, you've already lost. That's not investing, that's gambling in a suit and tie. There's a reason we never played that game. We liked sleeping well. We liked staying solvent. And we liked living to fight another day. People think risk management is some complicated math problem. It isn't. It's common sense. Don't borrow money to buy volatile assets. Don't chase returns you don't understand. And don't bet the house to win a tent. I've seen traders turn $1 million into $10 million and then back into nothing, all before lunch. The market is merciless to those who mistake luck for skill, and leverage amplifies both stupidity and arrogance to fatal levels. Let me tell you something Buffett once said that I never forgot. It's crazy to risk what you have and need for what you don't have and don't need. That one sentence should be carved into the desk of every investor on earth. Most financial ruin starts with the illusion of control. People convince themselves they can manage risk. But risk doesn't ask for permission. It just shows up uninvited, usually at the worst possible time. You don't control outcomes, you control behavior. That's why we built Berkshire the way we did. Minimal debt, enormous cash, and a tolerance for boredom. Boredom, by the way, is a superpower in investing. It keeps you from reaching for yield. It keeps you from tinkering when patience would do the job. And it keeps you from turning a solid strategy into a catastrophe because you got restless. The market punishes the impulsive and rewards the patient, but nobody likes hearing that. They'd rather believe there's a shortcut. There isn't. If you protect your downside, the upside takes care of itself. That's how compounding works. A 30% return isn't a straight line. It's a series of small wins stacked over decades without catastrophic losses in between. Most people can't handle that. They blow up chasing a few extra points. They forget that avoiding ruin is a return in itself. If you avoid losing half your money, you don't need to double it just to break even. That's how real wealth builds quietly, rationally, safely. So yes, rule number one sounds simple. don't go broke, but it's the foundation of everything else. Because when you stay in the game, time becomes your ally. When you're wiped out, time becomes your enemy. You can't compound from the grave. That's rule number one. Don't go broke ever. No matter how smart you think you are, the market doesn't reward intelligence. It rewards survival. If you want 30% returns, you can't act like a mutual fund manager. You can't own 50 mediocre stocks and expect extraordinary results. That's like filling your plate with junk and wondering why you're not healthy. The secret isn't diversification. It's selective concentration. When you find a situation where the odds are absurdly in your favor, you swing hard. And when they're not, you wait. Most people do the opposite. They bet big on hunches and small on conviction. Then they wonder why compounding doesn't work. I learned early that the market doesn't pay you for effort. It pays you for judgment. You can spend years analyzing nonsense and still be wrong. Or you can wait patiently for one fat pitch and make more in a single move than others do in a decade. Buffett and I built our entire philosophy on that idea. We don't try to be smart all the time. We try to be smart when it matters. That's a big difference. When you bet only when the odds are overwhelming, you reduce the need to be right often. You just need to be right big. In 1973, when the market was collapsing and everyone was crying, we were buying. Not because we loved pain, but because the math was irresistible. Good companies were selling for less than their working capital. It was like finding gold coins in a dumpster. The crowd thought we were crazy. But that's always how it feels when the odds are in your favor. They don't come wrapped in comfort. People forget that investing is a game of probabilities, not certainties. If you can recognize when the odds tilt heavily to your side, you don't need hundreds of bets. You need a few extraordinary ones. Think about it. If you find 10 situations in your lifetime where the risk-reward ratio is 5-1 and you act decisively, you'll outperform 99% of professionals. But to do that, you have to do something they can't. Sit still the rest of the time. Patience is a skill nobody wants to learn. It feels unproductive, but in investing, doing nothing is often the most productive thing you can do. People ask Charlie, how do I know when the odds are overwhelmingly in my favor? Simple. When the opportunity is so obvious, it almost feels stupid not to act. When the math works, even if the world doesn't cooperate. When the downside is limited and the upside is ridiculous. You don't need fancy models or 30 spreadsheets. You just need a working brain and a skeptical attitude. Buffett and I call it the no-brainer zone. If we have to debate it too much, it's probably not a no-brainer. We pass. Of course, this rule sounds easy, but in practice, it's torture. Because waiting for fat pitches means long stretches of boredom, and boredom kills more investors than bad analysis ever will. The world teaches you to stay busy. The market rewards you for staying patient. Most people can't handle that contradiction. They want activity. They crave movement. So they trade, they speculate. They nibble at mediocrity because waiting for greatness is emotionally painful. That's why they'll never get 30% a year. They confuse motion with progress. When we bought See's Candies in 1972, it wasn't because it looked exciting. It was because it had a durable brand, pricing power, and an emotional connection with customers. We paid a fair price for a great business, not a cheap price for a bad one. That single purchase changed the trajectory of Berkshire Hathaway forever. It taught us that one truly great idea is worth more than 100 average ones. And the best part? It kept compounding quietly while others chased the next miracle stock. People often ask me if I believe in risk-taking. You don't. I believe in calculated risk-taking. There's a big difference. Jumping out of a plane without checking the parachute isn't courage, it's stupidity. But if you've inspected the chute, studied the wind, and picked the right height, then it's a calculated jump. That's how you should invest. When the setup is right, you go big. When it's not, you go fishing. The biggest money we ever made came from a handful of bets. Coca-Cola, American Express, Apple, We weren't smarter than the market. We were just more selective than the market. Most investors buy over diversification. They spread themselves so thin they can't even remember what they own. Then they spend the rest of their lives hugging the index and pretending it's wisdom. If you want 30% returns, stop trying to be safe by being average. Average is safe only until the tide turns. So here's the second rule. When you find an opportunity where the odds are absurdly in your favor, bet big. And when you don't, do nothing. You can't compound like a genius if you behave like a gambler. But you also can't get extraordinary returns if you never take extraordinary action. That's the balance. Avoid stupidity most of the time. Act decisively when the odds finally shout your name. That's how you earn 30%. Not every year, but over a lifetime. It adds up to more wealth than most can imagine. You can't get 30% returns if you don't know what you're doing. That sounds obvious, but it's not, apparently. Most people in the market have no idea what they're buying. They just follow trends, headlines, and hunches, then call it strategy. If you don't understand it, you don't own it. That was my rule long before people started calling it value investing. Because investing is not about knowing everything, it's about knowing where you're ignorant. The size of your circle of competence isn't what matters. What matters is knowing its boundary and never stepping over it. When I was a young man, I watched people pretend to know things they clearly didn't. They spoke in jargon, quoted balance sheets, used big words like synergy and disruption. But when reality arrived, their portfolios evaporated. The problem wasn't lack of intelligence. It was arrogance disguised as knowledge, and arrogance is fatal in investing. You can't compound at 30% a year if you insist on touching every shiny object that moves. The world will always tempt you with something new. That's how it separates the disciplined from the doomed. Warren and I made a career out of not knowing. We ignored entire industries because they didn't make sense to us. Tech stocks in the 90s, we passed. Cryptocurrency in the 2000s, we passed. People mocked us for being too old or too slow. Meanwhile, we were getting richer quietly by staying inside the tiny circle we actually understood. If you can master just one corner of the world, truly master it, you don't need to dabble everywhere else. The returns from one good field can last a lifetime. Here's the irony. The market rewards humility more than brilliance, because humility keeps you alive long enough for brilliance to show. When you admit I don't know, you avoid traps. When you pretend I do, you build them yourself. Every big disaster I've seen, from long-term capital management in 1998 to the housing collapse in 2008, started with people stepping outside their circle of competence. They thought math could replace judgment. It never does. There's a story I love telling. A young man once asked me, "Charlie, how do I expand my circle of competence?" I told him, slowly, very slowly, preferably by reading and suffering. You expand it by learning deeply, not broadly. Depth beats width every time. The deeper your understanding, the fewer surprises you face. People think progress means doing more. In investing, it often means doing less but understanding it better. We once owned textile mills. It was the dumbest business you could imagine. Capital intensive, low margin, no pricing power. We thought we could fix it with intelligence. We couldn't. The economics were against us. That failure taught us something priceless. You can't make a bad business good by working harder. You can only make good decisions within industries that naturally reward good behavior. So we left textiles and focused on what we understood: insurance, consumer brands, finance. That shift created the Berkshire Hathaway everyone knows today. Staying within your circle of competence doesn't mean stagnation. It means compounding your knowledge where it actually compounds. Here's how you know you're inside your circle. You can explain why the business makes money in 1 or 2 sentences to a 12-year-old. If you can't, you don't understand it. And if you don't understand it, don't buy it. Most people's portfolios look like a junk drawer. A little bit of everything, nothing of substance. It's comforting, but it's not intelligent. They think diversification will save them. But diversification doesn't cure ignorance, it just hides it. 30% returns don't come from knowing many things superficially. They come from knowing a few things profoundly. When you stay inside your circle, mistakes are fewer, confidence is higher, and decisions are faster. That's how compounding really accelerates, not through constant movement, but through clear, repeated decisions within familiar territory. Remember, a small circle of competence, honestly recognized, is more profitable than a large one built on delusion. So rule number 3 is simple, but almost nobody follows it. Stay within your circle of competence. Don't stretch it to impress others. Don't fake it to look smart. If you respect the limits of your knowledge, you'll naturally outperform the people who don't. They'll drown trying to look like geniuses. You'll float quietly on common sense. And common sense compounded for decades looks an awful lot like genius. Patience is a rare trait in the stock market, and that's why it pays so damn well. Most people can't sit still. They'd rather make a mistake than look inactive. They call it being proactive. I call it being stupid in motion. You don't make 30% a year by chasing every idea that floats by. You make it by sitting on your ass when there's nothing worth doing and acting decisively when there is. The ability to wait is not natural. It's emotional discipline disguised as laziness. Humans hate inaction. We crave control. We want to feel productive, even when patience would produce more profit. That's why the average investor underperforms his own investments. He interrupts compounding with his own impatience. It's like planting a tree and digging it up every week to check if it's growing. The act of checking kills the growth. Warren and I built a fortune on boredom. That's not an exaggeration. For most of our careers, we sat around reading, thinking, and saying no. We only said yes a few times a year, sometimes once every few years. That's not a lack of activity. That's the highest form of discipline. We waited for the market to hand us stupidity on a silver platter. It always does, eventually. The world never runs out of folly. You just have to be around, sane, and liquid when it shows up. You can't time stupidity, but you can prepare for it. The best opportunities come when everyone else has lost their minds, either on the upside or the downside. You can't see clearly in those moments unless you've trained yourself to do nothing while others panic. That's what waiting really is, emotional conditioning. It's saying, I'll play only when the odds are right, even if that means watching everyone else have fun for years. The people who can't wait call you a fool. Then they lose money. Then they envy you. It's a beautiful cycle, as predictable as gravity. The truth is, doing nothing feels unbearable because it forces you to confront uncertainty. And most people would rather be wrong than uncertain. They'd rather act even stupidly just to silence the anxiety of inaction. They want the illusion of progress. But progress in investing doesn't come from activity. It comes from compounding. And compounding needs time, not motion. Look at the great investors in history. Their defining trait isn't constant activity. It's selective aggression. They wait and wait and wait, and then strike like a cobra when the moment comes. In contrast, the amateur investor behaves like a pigeon in a casino, flapping everywhere, chasing crumbs, bumping into mirrors, busy, noisy, and utterly doomed. During the 1974 bear market, everyone thought the world was ending. Stocks were cheaper than wallpaper. We waited. We watched. And when the panic peaked, we quietly bought businesses at pennies on the dollar. No genius involved, just patience and liquidity. The people who mocked us for being too cautious in good times were broke by bad times. We were ready. They weren't. That's the hidden advantage of waiting. It builds optionality. When you're not busy doing dumb things, you have the resources, financial and emotional, to act when opportunity finally appears. The market's greatest trick is convincing you that activity equals intelligence. It rewards the loud, not the wise. It glorifies hustle over thought. But the older I got, the clearer it became. The quieter you are, the better your results. Real investing isn't about excitement. It's about endurance. You survive long enough to see the math of compounding work in your favor. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." He was right. The impatient call it boring. The patient call it freedom. There's a reason casinos never go out of business. They feed off the inability to wait. The stock market works the same way, except here you can be the casino if you can master the art of waiting. You don't win every hand. You just wait for the cards to favor you, and then you bet big. That's how 30% returns are made, by not swinging at every pitch. Only the fat ones. So rule number 4, wait. Wait through boredom. Wait through doubt. Wait through ridicule. Because the moment of opportunity always arrives, and it belongs to the one who's ready, not restless. You don't have to be smarter than others. You just have to be more patient than them. And patience, in the long run, compounds faster than brilliance ever will. People spend their lives trying to be brilliant. I've spent mine trying not to be stupid. It's a much easier goal and far more profitable. Everyone's looking for the next great insight, the secret formula, the revolutionary theory. Meanwhile, I'm just sitting here asking, what can go wrong? Because avoiding stupidity is the closest thing to guaranteed progress that exists in investing. I learned this trick from mathematics. In math, if you can't solve a problem forward, you solve it backward. That's called inversion. You take the goal, flip it on its head, and ask the opposite question. Instead of asking, how do I become successful, ask, how do I guarantee failure? Then simply avoid doing those things. It's the same in investing. Don't ask, how do I make 30%? Ask, how do I make sure I don't lose 50? The answers are clearer, simpler, and much less likely to kill you. The world worships complexity, but most of the disasters I've seen came from smart people making things too complicated. They created systems they couldn't understand, leveraged positions they couldn't manage, and chased ideas they couldn't explain to a child. You can't compound money you don't understand, and you can't protect what you can't explain. That's why I've always said, it's remarkable how much long-term advantage people like us have by trying to be consistently not stupid instead of trying to be very intelligent. That's not modesty. That's strategy. Think about how most investors behave. They trade on emotion. They chase returns. They follow the herd. They read predictions written by people who can't even predict their own marriages. Then they blow up, blame the market, and start again, often with the same behavior. You can't fix stupid with more information. You fix it with fewer mistakes. If all you did was avoid the obvious blunders, overconfidence, envy, leverage, ignorance, you'd outperform 90% of investors without breaking a sweat. The problem is, people don't like the idea of avoiding. It doesn't sound sexy. There's no glory in, I didn't lose money this year. They want headlines, drama, and excitement. But investing isn't about excitement. It's about staying in the game. And staying in the game requires humility, the willingness to say, I could be wrong. That's what inversion forces you to do. It reminds you that reality doesn't care about your ego. It only rewards clear thinking and disciplined restraint. I once said, all I want to know is where I'm going to die, so I'll never go there. That's inversion in a nutshell. You don't need to know everything about success. You just need to avoid the paths that lead to ruin. There are fewer of them than you think, but they're clearly marked if you bother to look. Debt, arrogance, greed, impatience, they've killed more fortunes than bad luck ever did. And yet, every generation insists on learning that lesson the hard way. If you want to achieve 30% return, start by removing the behaviors that guarantee you won't. Stop trading every rumor. Stop investing in what you don't understand. Stop borrowing money for speculation. Stop confusing brains with bull markets. Avoid those four, and you'll be in the top 10% of investors instantly, not because you're a genius, but because you're rational. Avoiding stupidity doesn't mean avoiding action. It means acting only when the odds are sane. It means filtering opportunities through a simple question. If this goes wrong, will I still be alive financially? If the answer is no, walk away. If the answer is yes, and the risk is small compared to the reward, proceed carefully. That's inversion applied in real life. The beauty of this approach is that it compounds silently. Every avoided mistake adds invisible returns. Every missed disaster increases your future capacity to act. It's not dramatic. It's just relentlessly effective. The people chasing brilliance will keep making bold moves and bold excuses. You'll keep making quiet money. In the end, the scoreboard tells the truth. So rule number 5 is simple. Don't try to be brilliant. Just avoid being stupid. In a world obsessed with complexity, clarity becomes an edge. In a field ruled by ego, humility becomes armor. You can't always predict the future, but you can always sidestep the obvious traps. And over time, that's what separates the rich from the regretful. You can't get 30% returns with a mind that cracks at 5% volatility. That's the truth nobody likes hearing. The stock market doesn't test your intelligence. It tests your temperament. And most people fail that exam before they even finish reading the questions. The market is designed to exploit human weakness. Fear, greed, envy, impatience, those 4 destroy more portfolios than recessions ever did. If you can't master yourself, the market will do it for you, and it will charge interest. When I talk about psychology, I'm not talking about motivational posters or positive thinking. I'm talking about emotional control. The discipline to stay rational when the world turns manic. The patience to sit quietly when others are screaming buy or sell. If you can do that, congratulations, you're already in the top 1% of investors. Because the rest, they're ruled by hormones and headlines. During the dot-com bubble, I watched supposedly smart people lose their minds. They were buying companies with no earnings, no assets, and no business model. Just a .com at the end of the name. They called it innovation. I called it insanity in a tuxedo. Then, when it all crashed, they acted surprised, as if gravity had been suspended for a few years and suddenly turned back on. That's how most investors operate. Emotionally, not rationally. They don't have investment strategies. They have emotional reactions that look like strategies. Your psychology determines your returns far more than your IQ ever will. An intelligent investor with poor temperament will lose to a calm idiot every time. Because markets don't reward cleverness, they reward stability under stress. When everyone's euphoric, you should be skeptical. When everyone's panicking, you should be curious. That's contrarian thinking, but it's really just emotional independence. And that independence comes from understanding one thing. You don't need to participate in every drama the market produces. Warren and I don't watch stock prices all day. We read, we think, we wait, because noise creates stupidity, and stupidity creates opportunity, but only for those who can keep their heads clear. That's the real skill clarity under chaos. You can't buy it. You build it by enduring uncertainty and learning to enjoy your own company. Here's what most people never grasp. You don't need the market to behave, you need yourself to behave. The market will swing like a drunk for the rest of your life. If you can't stand that, you're in the wrong game. People panic because they believe volatility is danger. It's not. Volatility is the price of admission for superior returns. If you can't stomach it, you can't earn them. It's like going to a theme park and complaining about the roller coaster. You can either enjoy the ride or stand on the ground criticizing others for screaming. You must also learn to ignore envy. It's the most useless emotion in investing, And the most destructive, someone will always be richer, younger, or luckier. So what? Envy won't make you smarter or happier. It'll just make you reckless. People blow up their portfolios trying to catch up with someone they shouldn't even be comparing to. If you can eliminate envy, you remove half the stupidity in your financial life. Greed, on the other hand, disguises itself as ambition. It whispers, just one more deal, just one more trade. Then, when the tide turns, greed takes everything it once gave with interest. That's why rationality matters more than optimism. Optimism builds businesses. Rationality preserves fortunes. And then there's fear, the most natural but the most expensive emotion of all. Fear makes people sell wonderful businesses at the worst possible time. It makes them hide in cash while opportunity screams. It turns long-term investors into short-term traders and then into long-term losers. You don't beat fear by pretending to be brave. You beat it by understanding probabilities. You remind yourself that volatility isn't permanent loss. Panic is. I've always believed that controlling your emotions is like maintaining a margin of safety in your own mind. When your ego and your fear are both under control, you can think clearly. And clear thinking compounds. You can't get 30% returns by being the smartest person in the room. You get them by being the calmest. That's why I always say, if you can't watch your portfolio drop 50% without losing sleep, you probably deserve the lower returns you'll get for being emotional. So, rule number 6, master yourself before you try to master the market. The real competition isn't other investors, it's your own psychology. In the long run, markets reward the few who can stay sane while everyone else loses their mind. And sanity, when compounded, looks a lot like genius. Everyone talks about compounding. Few actually understand it. And almost nobody has the temperament to let it work. Compounding is simple in theory, brutal in practice, because the math only works if you don't interrupt it with your own stupidity. You don't need to be brilliant to achieve 30% returns. You just need to let time do what brilliance can't multiply quietly. The idea of compounding is older than the stock market itself, but most people still treat it like magic instead of mathematics. They underestimate what happens when small, consistent returns accumulate over decades. Einstein supposedly called compounding the 8th wonder of the world. He was right not because it's mysterious, but because so few people can emotionally handle how slow it feels. The first 10 years feel like watching paint dry. The next 20 feel like watching money grow on trees, but only if you didn't chop the tree down early. Here's the truth. Compounding doesn't reward intelligence. It rewards endurance. The longer your capital survives, the greater your advantage becomes. You can't speed it up. You can only destroy it by being impatient. That's why most investors never get rich, not because they can't earn returns, but because they can't keep them compounding long enough. They sell too early. They panic too soon. They chase the next shiny object. And in doing so, they interrupt the only force in finance that works without human interference. Buffett and I have joked for decades that our greatest achievement wasn't picking stocks, it was living long enough for compounding to work. There's truth in that humor. Most of Berkshire Hathaway's value came after Warren turned 60. Think about that. 6 decades of discipline, and then the snowball finally hit critical mass. That's how wealth works. It grows slowly, then suddenly, like watching glaciers melt until one day the valley floods. The tragedy is that most people sabotage themselves right before the payoff. They can't resist the temptation to take profits. They treat investing like farming but harvest before the crops ripen. Then they wonder why they never reach financial independence. Compounding rewards those who think in decades, not quarters. If you need excitement, go to Vegas. If you need wealth, sit still and let time work for you. When I was younger, I underestimated the psychological side of compounding. It's not just math, it's identity. You have to become the kind of person who can wait 20 or 30 years without losing faith. That's rare, but that's where 30% returns hide in the patience nobody else can tolerate. Because the truth is, compounding isn't exponential growth, it's exponential boredom. And most people can't stand boredom. They'd rather ruin the formula than endure the silence. The most powerful part of compounding is not the interest itself, it's the habits that allow it. Frugality, consistency, rationality, patience. Those four are the real engines behind 30% returns. They're boring virtues, which is why they're rare. But the market quietly transfers wealth from the restless to the patient every single day. If you want to understand compounding, don't look at charts, look at character. Because character determines who can sit still when the world tempts you to move. And every unnecessary move costs you years of growth. A fool measures success in weeks. A wise man measures it in decades. That's why we never sold See's candies. Why we held Coca-Cola for decades. Why we let Apple buy back its stock instead of trading it like a toy. We weren't looking for excitement. We were looking for inevitability. The irony is, the older you get, the more powerful compounding becomes, but the fewer people stick around to enjoy it. That's why longevity and rationality are the best partners in finance. Live long, think long, actorarly, and compounding will do the rest. Most people underestimate what a steady 20% return can do over a lifetime. A few understand it, a smaller few actually live it, and almost none have the emotional discipline to wait long enough to see it unfold. So rule number 7, let time work harder than you do. Don't interrupt compounding. Don't tinker. Don't get clever. If you want 30% returns, start by earning 20 and not losing it. Do that for 30 or 40 years, and you'll look like a genius even if all you did was stay sane longer than everyone else. Because in the end, wealth doesn't come from speed. It comes from duration, and time properly respected is the greatest investor of all. Ego is the most expensive thing you'll ever own. It costs you opportunities, relationships, and returns, usually all at once. People think intelligence makes them rich. It doesn't. If that were true, every professor would be a billionaire. What really builds wealth is humility, the ability to say, I don't know, and act accordingly. Ego tells you to predict. Humility tells you to prepare. And in this business, the man who prepares always beats the man who predicts. You can't achieve 30% returns if you're busy proving you're smarter than the market. The market doesn't care about your IQ. It only cares about your discipline. Ego wants control, but markets are chaos. The more you try to dominate them, the more they humiliate you. That's why the graveyard of finance is filled with geniuses who thought they could outsmart uncertainty. I've seen it my whole life. Smart people doing dumb things because they couldn't stand being ordinary. They'd rather lose money flamboyantly than make it quietly. They want to be right, not rich. And those two goals rarely coexist. Buffett and I never tried to look brilliant. We tried to look sane. There's a big difference. Sanity compounds. Ego explodes. If you can't handle being wrong occasionally, you'll never survive in investing. Because every great investor has been wrong often, spectacularly. The trick is not avoiding error, it's avoiding ruin. Ego magnifies small mistakes into career-ending disasters. Humility keeps them manageable. That's why humility is a form of risk management. It limits your downside by keeping you skeptical of your own ideas. The moment you believe you can't be wrong, you've already guaranteed that you will be. I've always preferred a simple question over a brilliant theory. Could I be making a mistake here? That question has saved me millions. Meanwhile, people with PhDs and mathematical models have gone broke pretending the world is predictable. They confuse precision with understanding. They build equations with 14 variables and forget that one irrational human can destroy it all in a day. You don't need complexity to make money. You need clarity. And clarity comes from humility, knowing what you know, knowing what you don't, and staying within that boundary. Ego loves leverage. It loves showing off. It loves being admired for taking bold risks. But wealth isn't about applause. It's about endurance. When you stop caring what others think, you start compounding faster because your decisions are no longer driven by social pressure, only by logic. That's why Warren and I never cared about quarterly rankings or headlines. We cared about not going broke. And that humility, that willingness to look boring for decades made us rich. Ego also blinds you to opportunity. When you're full of yourself, there's no room for new ideas. You stop learning. You stop listening. And in a world that constantly changes, arrogance is suicide. I've said it before. The game of life is a game of continuous learning. Those who keep learning will keep rising. Those who think they already know will keep falling. The best investors I've known were always students, curious, humble, hungry to be proven wrong. The worst were the ones who thought the market owed them a victory. Ego makes you chase trends you don't understand just to prove you're in the game. It makes you overtrade when patience would pay more. It makes you brag when you should be studying. And worst of all, it makes you double down when you should admit defeat. I've never met a humble man who went bankrupt because he was cautious. But I've seen dozens of arrogant men go broke because they couldn't say, I made a mistake. That's the hidden cost of ego. It takes away your ability to learn. And without learning, you're done. Humility isn't weakness. It's strength in disguise. It's the ability to face uncertainty without collapsing. It's what keeps you liquid when others drown in confidence. You'll notice the pattern. The investors who survive decades aren't the loudest. They're the quiet ones. They don't predict, they adapt. They don't boast, they endure. They understand that in the long run, the scoreboard rewards performance, not personality. So rule number 8, and perhaps the most painful to learn, is this. Kill your ego before it kills your portfolio. You don't have to be brilliant. You just have to be teachable. You don't have to be loud. You just have to be right eventually. Humility keeps you solvent. And solvency, compounded for decades, beats genius that implodes every few years. Remember, the world is full of smart people who couldn't stay rich and humble people who quietly did. After 90 years of watching the markets, I can tell you this. The secret isn't brilliance. It's endurance. People waste their lives searching for shortcuts. They read new books, chase new fads, follow new gurus, all trying to outsmart a game that hasn't changed since the first trade was made. The market rewards a few simple behaviors, practiced relentlessly for a very long time. Everything else is noise. You want 30% returns. Fine. Earn them the hard way, the only way. By staying rational while others lose their minds. By sitting still while others chase motion. By buying quality when it's cheap and holding it when it's dull. There's no magic formula. Just discipline, patience, and the ability to ignore 99% of what people call advice. Let's recap. Rule 1. Don't go broke. Ever. Rule 2. Bet big when the odds are overwhelmingly in your favor. Rule 3. Stay within your circle of competence. Rule 4. Wait and make peace with boredom. Rule 5. Invert. Avoid stupidity instead of chasing brilliance. Rule 6. Master your own psychology before trying to master the market. Rule 7. Let time and compounding do the heavy lifting. And if I might add an 8th, keep your ego on a leash. Do that, and 30% returns stop being fantasy. They become arithmetic. Most people can't follow those rules. They're too simple to seem impressive and too hard to live by. But that's exactly why they work. Complexity gives comfort to fools. Simplicity terrifies them because it demands restraint. Restraint is the rarest trait in finance. Everyone wants to do something. Almost nobody wants to wait for something. That's why the world keeps producing average investors and rich brokers. In all my years, I've never seen anyone go broke by being rational. I've seen thousands go broke by being emotional. The difference isn't intelligence, it's temperament. The calm mind outlasts the clever one. The irony is, the more rational you become, the less exciting your life looks from the outside. No drama, no chaos. Just a slow, steady climb. But that's how real wealth feels: quiet, not loud. Boring, not flashy. Certain, not thrilling. When I was younger, I thought success was about brilliance. Now, I know it's about survival. If you can stay solvent, sane, and patient for 50 years, the math will take care of the rest. The world will hand you opportunities simply because you're still around to notice them. Longevity and rationality beats short bursts of genius every time. Most people will never understand that. They'll keep gambling, speculating, and envying. They'll keep mistaking noise for knowledge and luck for skill. They'll keep asking, what's the next big thing? Instead of asking, what can I avoid screwing up today? And when they fail, they'll blame the market, not the mirror. I'm not smarter than the crowd. I've just made fewer dumb decisions. That's it. That's the whole story. I didn't chase excitement. I chased rationality. I didn't seek applause. I sought peace of mind. And over time, those choices turned into wealth, not just financial, but intellectual. You see, money's only one form of wealth. Wisdom is another. And the older I got, the more I realized that wisdom compounds too. If you keep learning, keep questioning, keep inverting the return spill into every part of your life. That's what I mean when I say, take all the brains and energy you have and devote it to becoming a little wiser every day. If you do that, the money will follow quietly, relentlessly, inevitably. So when people ask me, Charlie, how can I get 30% returns a year? I tell them, stop focusing on returns. Start focusing on behavior. Because behavior compounds faster than capital. And rational behavior, practiced for a lifetime, turns ordinary investors into legends. The math of compounding is simple. The psychology of compounding is not master both. And you'll understand why patience, not brilliance, runs the world. And if you forget everything else I've said, remember this. You don't need to be extraordinary to get extraordinary results. You just need to avoid stupidity long enough for the extraordinary to happen on its own.
本视频深入探讨了传奇投资者查理·芒格关于实现30%年化收益的独特哲学。他强调，高收益并非魔术，而是由耐心、纪律和避免愚蠢行为驱动的算术。视频指出，大多数人追求非凡结果，却不愿过非凡生活，热衷于追逐潮流，过度多元化，盲目投机，最终导致损失。芒格提出了8条核心原则，首先是不要破产，强调生存的重要性；其次是在胜算极高时大胆下注，而非频繁交易；第三是坚守能力圈，避免在不熟悉的领域冒险；第四是拥抱无聊，以耐心应对市场波动。他还提倡反向思维，通过避免愚蠢而非追求聪明来获得优势，并强调掌握自身心理，让时间复利以及克制自我膨胀的关键作用。最终，视频总结道，财富并非来自速度或花哨的策略，而是源于长期的坚持、理性和更少的错误，是耐心和智慧的无声累积。